quickly now to Ahmed Al-Nadi, who is head of hotels and hospitality at JLL, based in Dubai and covering business strategic growth across the Middle East and Africa. Amir, if I leave you to have your discussion with the investors.
Thank you so much, Matt. Amazing session from Mark Dunford and Mark Willis. Here you go, Dunford. I did mention your name this time, so definitely not forgotten. So to Matt's point, today's session is really about the conversation with the investors. It's really time to discuss and to put in perspective today how are the investors are effectively, gauging the appetite. What are they looking for as we effectively slowly start entering into that recovery period? Today, how is all of that translated into investment criteria, into appetite? And it's important for our audience to get a little bit of perspective into that respect. So before I introduce my panelists shortly, what I'm going to do is that I'm just going to share some data with you, try to give you a little bit of our KPI statistics, what's been happening in the international hotel investment landscape, and then we're going to narrow it down to the European scene, and then afterwards we're going to cover Morocco in a little bit more specifics. So just allow me to share my slides into the screen. I hope everybody can see this. So for those of you who don't know me, my name is Amr Al-Nadi. I manage JLL's hotels and hospitality team for the Middle East and Africa. And I also sit on the Global Hotel Desk board of JLL, whereby we purely focus on cross-border capital. In this context, we work with the Middle Eastern community who are keen to effectively acquire and invest into hotels outside our region. And also for those, and we attend to those who have hotel interests outside the Middle East and require effectively our assistance. So just to put things in a little bit of perspective, let's start with the global hotel investment volumes. After an amazing recovery cycle, basically over the past 6 to 7 years, we've been seeing an average of approximately $60 billion up to $70 billion worth of hotel investments per annum. There was no surprise that 2020 effectively halted that momentum. We've seen investment volumes decrease by 63% in 2020, evidencing the substantial change in priorities amongst all stakeholders, including but not limited to hotel investors, operators and tenants, as well as lending institutions. Despite the numerous distress opportunities we're currently witnessing, in the Americas, the EMEA region, so Europe, Middle East, and Africa, retained the leading position for the first time in many years around the hotel volume, or let's say the investment volume dedicated to hospitality, with very little distress in sight. That $11.1 billion out of the 26 effectively reflects 42% of volume market share. Despite the ongoing reigning uncertainty around travel movements, the shock movement is slowly dissipating, and we're expected to see global hotel investment volumes increase by 35 to 40% in 2021. Liquidity for that volume will be effectively supported by private equity groups in possession of record levels of dry powder and high net worth individuals as well as families. So if we take a bit of a deeper look around Europe, Middle East, and Africa, who were the most active buyers in 2020? Nearly 50% of the investment volume was generated during only the first quarter of 2020. And at that time, really the impact of the pandemic was not clearly seen. There was whispers, there was talks, it was still news at that time. And in essence, this did not hold effectively investors from completing the transactions, either that commenced early Q1 or effectively that were carried forward from the end of 2019. So if we look at the rest of the year between Q2 and Q4, it's pretty much almost the same amount. So let's say draw a circle around 5 billion for the first quarter and another 5 billion euros during the rest of the year. From an origin standpoint, 80% of the capital, or let's say the buyers for these acquisitions, were European or domestic, and 20% of those were effectively international. And in terms of buyer type, we've seen in 2020 that private equity dominated the larger market share with 37%, followed by institutional investors with 25% of the total market share, then developers, property developers at 10%, high net worth individuals were at 7%, hotel operators were at 6%, and the rest were in the others category. Even though private equity proportion did decrease, trust me, they're still out there and they're waiting. In 2029, if I put that a little bit into perspective, the landscape was, still remained dominated by institutional investors and private equity. And at that time, the allocation towards hotel real estate was far bigger from a proportion standpoint vis-a-vis the other asset classes, if we want to compare it to commercial space, retail, shopping, industrial, etc. There was good travel returns basically at that time, but we know that the scene is changing, so everybody's kind of back to the drawing board and reassessing the opportunities. In this slide, I just wanted to highlight effectively the difference, let's say the difference of this particular crisis compared to the one we witnessed nearly 11 to 12 years ago. There's a lot of capital out there. That's basically the summary of it. According to our latest research, we have pent-up demand for real estate investment, commercial real estate investment, and we've accounted for approximately $87 billion at the moment, waiting on the sideline and waiting to be deployed. To put things in a little bit more perspective, the US CMBS market that's allocated or dedicated to hospitality only is around the 90 billion US dollars. So I think you can really assess the impact that the US is witnessing compared to the other side of the Atlantic, basically. These are some of the 2021 trends that we need to look out for. And we really wanted to highlight, again, just some examples here, either from an operational standpoint or from an investment standpoint. Clearly, look, profitability, positive cash flows is very much on everybody's mindset, whether it's owners, whether it's operators. And today it's really around retaining and try to mitigate losses as much as possible. There was some very strict and quite stringent measures taken in place during 2020. As some of the markets reopen, so to Mark Willis's point earlier, just around booking trends and the increase in pace, at the moment, owners are not fully just reopening their properties the same way they were pre-pandemic era. There are much more calculated initiatives being taken into consideration. Today, all secondary ancillary costs are being revisited in respect to staffing. Should we bring back everybody? Who do we retain? How's the evolution of the recruitment process going to be carried out? And all of these considerations, in my personal opinion, are effectively going to last for at least the next 18 to 24 months until we reach somewhat in the next 3 to 4 years the performance levels that we had witnessed pre-COVID-19. So to jump on the Moroccan tourism and hospitality market, this is just a snapshot where we really try to combine all the major KPIs, either pertaining to tourist arrivals, hotel market performance, current or future hotel supply, and what are the opportunities we're witnessing. If we start off with the tourism statistics, it's clear that the numbers show some sort of a resilience and sustainable growth since 2010. Morocco's witnessed quite a few volatile and actually geopolitical events that could have caused some major damage around the tourism arrivals. But nevertheless, we really see that resilience, at least from 2010 until 2016, between the 9 to 10 million international tourist arrivals. And then as of 2017, we've seen a lot of effort being put in place in diversifying the demand and not just purely relying on the European or continental European segments, but effectively going more to the Asian segments, the Middle Eastern segments, and the US markets. And that effectively resulted in a significant increase and a peak of 13 million international tourist arrivals in 2019. No surprise in 2020. I think that decline shows approximately 80% decline compared to the prior year, but that is very much in line with what we're seeing internationally, and again, reflective of the passenger movements. Unless I'm terribly mistaken, for 2021, we do expect to see some sort of a rebound around passenger traffic movement. I don't think we're going to reach the 9 million passengers, but we could be somewhere around the 5 to 6 million to international tourist arrivals. Moving on to the market performance. So despite the supply and increase, you can again see a fairly resilient and relatively healthy RevPAR levels until 2019, and that really shows a bit of a stagnation just around the occupancy levels being from your mid 50s% up to low 60%, and the rate has always been within the low hundreds dollars, resulting in either mid to low to mid, my apologies, RevPAR levels, 60-ish dollars, let's say. I'm personally adamant and favorable in retaining rate vis-a-vis, as opposed to slashing rates just to entice and enhance demand. It's always very difficult to recoup that loss once the market recovers. So if we look at 2020, that's perfectly well reflected in having a market-wide ADR of approximately 106, well, let's say $110 for quality hotel assets, despite the low occupancy of 21%. Moving on to current and future supply of hotel rooms, again, fairly sustainable, quite resilient, moderate level of growth. We're looking at somewhere between 4 to, let's say, draw a circle around 3,000 up to 4,000 keys being developed per annum. They're fairly selective. We're not seeing as opposed to what we're seeing in the Middle East, or let's say the GCC region, a lot of these giga projects coming up. We're seeing a lot of conversions, single asset projects being redeveloped, existing stock being converted, and that is effectively what equates to that future supply. At the same time, as much as there is resilience and there is a bit of appetite around hotel construction, we have seen that the banks were not fully responsive, depending on the model or the operating model of the hotels they see, especially around resort areas. But this is something my panelists and myself will touch upon over the session just shortly. And just to summarize, the growth and challenges. Just to name a few, I just want to conclude this slide by saying that, in our opinion as advisors, Morocco is definitely way ahead of so many neighboring Arab countries and African countries. Morocco was the first country to really receive quite a solid proportion of international capital, dedicated not only to institutional product, but also high-end resorts, luxury core assets between, Marrakech, the Agadirs, and the Casablancas of the world. That is not just related to the proximity of Morocco from a geography standpoint vis-a-vis Europe, but we have seen private equity looking into, the Four Seasons in Marrakech, the Westmont deal in Casablanca for the acquisition of the Sheraton Hotel. So these are great stories, that we effectively need to build on. And this is not just an owner or a singular effort that's being carried out by the owner community, but it's very important as well from a lot of the bodies that do want to look at foreign capital coming into Morocco to put these stories forward. So without further ado, allow me to introduce you to our panelists. So we have, starting maybe with the host, Mr. Jalil Benabes, Tarji. Jalil, I hope you're well. Jalil is the CEO. Jalil is the CEO of Morocco-based Tikida Group, a family business and a leading hospitality developer. Tikida owns 10 hotels developed and operated with partners like Riu Hotels and Resorts, Robinson Club, and Barcelona Hotels. They also operate directly at Relais Chateau, a boutique hotel based in Agadir with an iconic 36 hotels. Their portfolio equates or totals approximately 3,000 hotel rooms spread out between Agadir, Marrakech, and Casablanca. Jalil also presides the National Association of Tourism Investors, ANIT, and it is my personal honor, to have him with us in this session, and also an honor for me to call him a friend. We also have Mr. Adam Nisbet, who is head of investments for GRIT, Real Estate Income Group. Adam joined GRIT in May 2019 as head of investments. He was previously with Collins Property Projects, where he held the position of development director, responsible for all the group's development and refurbishment projects in Africa, with direct involvement in the asset management function. GRIT, for those of you who don't know, is a leading Pan-African real estate company focused on investing in and actively managing a diversified portfolio of assets in select African countries. Their high-quality assets are underpinned predominantly by U.S. and euro-based denominated long-term leases, and that's going to be very interesting to discuss these shortly, as opposed to Jalil, who effectively carries out a portfolio that is mostly exposed to operational risk. But nevertheless, we're going to talk about these covenant strengths. We're going to talk about these tenants, and welcome everyone. I don't think David is going to join us from Omnum, unfortunately. So Jalil and Adam will, I think, will do for today. So Jalil, can you hear me well?
Yes, very well. Thank you. Hello, Ahmed. It's a pleasure.
Fantastic. So look, let me start with you being on the ground. And I think, look, you've seen it all as a hotel owner, operator, and as well as tenant for, mashallah, quite a large portfolio. What are now your top priorities ahead of a potential recovery?
Well, first of all, I would like to thank Bench and Smith for organizing all this, and you for hosting us during this session. Well, to go straight to the question, what we really focus on is securing, let's say, the global and good shape of our balance sheets in the very short terms. Also, I would say the readiness and the good maintenance of our hotels and assets. And let's say, last but not least, to secure our human resources, and they're coming back to work in a good spirit and with a positive perspective. These are the main topics that we work on. Of course, not the only ones, but probably our priorities.
Very good. And look, I mean, again, as we move along into 2021, and despite a little bit of some of that positivism in the air, are you in acquisitive mode or are you still defensive?
Well, neither one. We're basically very open-minded, pragmatic. We observe, we talk a lot. We talk more than usual. We talk with our partners. We have a lot of interaction. We may be more demanding in terms of competitiveness, in terms of attractiveness of each product that is being studied or proposed. We also pay attention to new products, new offers, apart from mere hospitality. But to go back to hospitality, our thinking, our analysis as owners and developers are done on a frequent basis with all our partners. European partners, international partners like Rio, like Barcelona, like Robinson, like else, and we are very interactive. We believe the operators hold the real experience, the real touch on the market. We have other concerns, so we try to have it, all balanced in a very, let's say, reasonably coherent equation. So this is how we are now, and we do it step by step. We don't ambition to anticipate everything. We don't ambition to understand everything. We do it step by step, like bon père de famille, as we say.
Right. Okay. No, listen, that's very interesting, and I'm happy you touched base upon, securing your balance sheet, securing your HR. So maybe just before I move on to Adam, if you were to reopen fully, your hotel properties, and I know that most of them are operational at the moment, but what are the main differences you would be applying from an operational standpoint this time, as your hotels reopen and begin welcoming guests again?
Well, yes, I'll answer, but indirectly, what we have been focusing on really is to let's say be good pupils. It means we are following and going by the rules recommended by the government, and more specifically the Ministry of Tourism. We are certified as Welcome Safely hotels. Welcome Safely is a certification by local Moroccan authorities, and they really comprise both, let's say, rules and standards for the building, for the hardware, but also for the training of the human resources. This is what we go by, but also we go by the standards of our partners. So they usually go very much together, no big differences, and this is our main, let's say, priority. But to make it short and to say it in another way, we really focus on health and safety, both for our guests and for our human resources, and to be ready for what we believe could be a strong rebound, but that of course will depend on the segments and on the market and on the destination.
Right. Okay. Thank you, Julia. That's very. I'll come back to you in a second. Adam, are you with us? Can you hear me well?
Yes, I am here.
Fantastic. How are you doing? You well?
Very good, thanks. Yeah, nice to be here, and thanks for having me. And
Super.
Rather you than me to moderate this. So
one day, Adam. Wishful thinking. Obviously, they got the hot seat. No worries. Adam, your model is fairly different than the one adopted by Jalil and his company. So effectively, your entire hotel portfolio is actually subject to tenancy agreement. So, and I understand the current concentration is the most in the Indian Ocean, but have you had any challenges with your tenants or your operators in respect to rental obligations? And if you did, were you able to overcome them?
Yeah, absolutely. I think I'd certainly be lying if we said we've had no challenges on our side. I think just to speak to the model that we put in place, I think it is unique. It's obviously something that does protect us in terms of the bankability of the transaction. Often from our side, it's a fixed lease with the underlying hospitality operators. So, we take on these assets on the basis of fixed lease and don't take that underlying hospitality risk. Obviously, in times such as this pandemic, we're forced to get involved. We obviously have to be open with our tenants. We have to engage with them. We have to ensure that we work with them to get them through this period. So, we certainly do become hands-on in this process. The sorts of challenges, I guess, the cash flow that's required from the tenants. Effectively, our tenants and hospitality operators are looking for breathing room. Whether that's in picking out rents or getting involved with certain capex requirements to try and take the pressure off them. But it's a difficult one because we ourselves as landlords have fixed obligations to the likes of the banks and to shareholders, and to an extent they're understandable. But at the end of the day, we have our own obligations. So it's a case by case basis. I don't think you can apply one size fits all. By any means, it's down to the deal that was done on that particular property. It's down to the strength of that operator and how much support they actually require.
Yeah.
And I think that's how we like to think of it, is that we will engage one-on-one. We'll have honest conversations with the tenants. We'll put in place strategic action plans to ensure that tenant survives. And comes out the other end and can actually have a thriving business going forward. I think where we are protected, our partners as part of Grita, the Lux Group in Mauritius, the Beachcomber Group in Mauritius, Club Med, these are big groups with big balance sheets and big sort of shareholders behind them, so they have the ability to weather a lot of the storm. But certainly. This has been prolonged now, so we've had to get involved from our side and obviously engage with them on that basis.
Right. So clearly, covenant strength is really, really key for you guys when you underwrite an acquisition. It's not just about rental levels and duration of the lease, which I believe was also something that was touched upon on so many occasions. In the Middle East, a market that is still fairly infant around the leasing model, but considering all these factors, Adam, are you still bullish around hospitality in general, or are you guys, changing or revising your strategy in the medium term?
I think from our side, it's I think Jalil sort of used the word. It's an opportunistic or entrepreneurial approach to deals on a deal by deal basis. we're certainly not closed to new opportunities in the hospitality space. From a GRIT group perspective, we have exposure at a group level, which needs to be measured in terms of the growth that we have in hospitality versus the other asset classes. Our group model is very much a diversified approach across different asset classes. So we would need to grow hospitality in line with the likes of industrial exposure and office exposure, etc. In saying that, we are considering hospitality transactions, so we're still open to them. I think what it will come down to, what is that underlying covenant? What are the terms of the underlying deal? Certainly, we will be more selective, in terms of our approach. We will certainly consider all aspects as we would have before, but even more so in terms of just what the hospitality industry is coming out of following this pandemic and being prudent in that regard.
Right. So maybe to put that context, into context and just into numbers, let's say, if we were to look at your investment criteria, if it's not too confidential, but what sort of yields or IRRs you would target at the moment? Because a lot of the hotels, if I was purely going to look at cash flows, are probably not going to generate a lot of cash flow even in 2021. But so as you go forward, if you're going to rely on a bit of a solid rental model, what sort of returns are you guys targeting from an institutional standpoint?
Yeah, I think it's an interesting question. We don't so much focus on property yield or investment yield at in-country level. I think what really matters from our perspective is the returns back in Mauritius, where our head office is based, and where all the returns are driven. So I guess we understand that on a fixed yield type of model, we would need to be as aggressive as possible in terms of acquiring that asset at the lowest possible yield, or developing that asset at the lowest possible yield, whatever the case may be. Because obviously we have rental that comes out the other side as a fixed obligation to the operator, that they're trying to negotiate that down as much as possible. So it comes down to where we can fund it. So typically where our yield can be positioned is a product of where we can fund from, and the sort of cost of funding rates that we can get into the transactions. And that comes down to, that cost of funding comes down to the strength of the covenant again, and the length of tenure. So it's all driven on that basis. I think I don't want to not answer your question. So I think, the actual yield, I think, as a benchmark between 7 and 8% in hard currency is where these fixed yields are sitting. I think on the percent side is aggressive for us to get involved. It would need to make sense in terms of where that funding rate would sit. But this is, these are the moving parts which eventually would drive a minimum return back to our shareholders in Mauritius, which is what we really target.
Listen, that's very clear, and I'm happy you touch base upon funding today. So presumably, if you were to look at acquisitions and you had to combine in your capital stack a proportion of equity, vis-a-vis third-party financing or third-party lending, from my own experience, even before the pandemic, so despite being faced with several very attractive opportunities in Morocco from an acquisition or disposal standpoint, we've always found a bit of additional scrutiny from the lending institutions, from the banks around hotel investments, especially the ones that were catered to operational risk or standard management agreements. Is this a challenge, for example, you're facing when you underwrite, let's say, fixed lease acquisitions?
Well, I think it becomes a lot easier. I think it's the driving factor behind us putting forward that fixed lease model. Obviously there's pushback from operators. I think an operator is never going to choose to sign up for a fixed lease and a fixed obligation. They prefer to do a management contract or some sort of hybrid model between the two. But where we can really get aggressive is in funding that deal based on that fixed lease, at the most aggressive rates, to give that yield, make that yield as aggressive as possible. So yeah, whether those sorts of deals will be as readily available, I think operators will be even more nervous to enter into these sorts of agreements going forward. I think they'll be looking to protect their risk. But in saying that, I guess it depends how the industry bounces back. It depends on the recovery of some of the bigger operators and their willingness to enter into these discussions. Yeah, but to answer your question, that is the driving factor. The bankability and the debt terms that we receive are only there because of the fact that there are these underlying covenants. I think if that's a management agreement and we're going to the bank on that basis, that's a very different discussion and one which becomes very difficult to bank, requires a lot of equity, requires very low gearing typically, and higher costs of funding.
Right. Listen, I think that's very consistent with what you've seen. Let me turn this question around to Jalil. Jalil, I know you have a few leases, but you also have quite a significant amount of operational risk exposure. If I would say, how were the banks being responsive to you, let's say over the past 12 months, if it's okay for you to share? Jalil? I'm not sure if he can hear us, or maybe on mute.
I was asked to cut my mic, sorry.
Oh, no, sorry.
Yeah, really, the banks in Morocco have been quite responsive, truly. Probably it's also related to each one of us and the credit history of each one of us and the credit rating, obviously. But I should add that the government also has been quite active in that aspect. We have activated a lot of guarantees for all the new loans that supported the new loans for the operations of the hotels, the BFR, and also to support the banks through the Caisse Centrale de Garantie, the CCG, who has done a very tremendous effort during all this year, and probably also during the 2029. So globally, the cooperation has been very positive, responsible, and productive. In parallel, I should add that there will probably be a difference of treatment between, let's say, assets or hotels or businesses that were viable before COVID and those who were not. And this is only legitimate. So banks will make differences. So probably I'm not the best source for this for an opinion, for a neutral opinion. But globally, yes, banks have been quite positive, quite open, quite supple, and they're still being in 2021. We are currently discussing a global restructuring of the debts globally. Of course, it will be applied differently from, let's say, one company to another, but it is being done and negotiated in a very, let's say, promising way. So we are quite optimistic on this aspect.
Right.
Apart from the many the many tools that were used by the government to support, let's say, the salaries, to support some of our expenses. I will not go into too many details, but also for the treatment of the amortizations of the fixed expenses over the next 5 years. So we've had some tools to let's say, to shape or to model our balance sheets for 2021 and even above.
Right.
To kind of preserve shareholders' money, at least relatively.
Absolutely. And look, that's very much aligned. I'm happy you mentioned, the government support and a lot of these proactive initiatives being undertaken by the lending market. It's something we've seen as well being applied in markets like Spain, and other, let's say, European countries, and that effectively reduces the damage, of many hotel properties facing foreclosure. Unlike the other side of the continent, what I was mentioning earlier, the US, of which a significant number of hotel rooms is exposed to CMBS. So commercial mortgage-backed securities lending model, and those are very much less, let's say, less cooperative than relationship banking, and it's why we're seeing a lot more distress or potentially assets that are going to go into special servicing, vis-a-vis what we're seeing in the EMEA region. We're not seeing at all the, let's say, the expected proportion of distress or distressed opportunities, as someone would effectively want to see or hope to see. God forbid we don't want to see that, but if you were to underwrite it on that basis, it's quite thin at the moment. But the second half of the year, who knows?
Yeah, but globally, still, it will, with all the help, it will still be very tough on the industry.
Absolutely, no, 100%. That's why I'm saying
and every segment and big companies and small companies is going to be very tough.
Absolutely,
we'll have to talk about it next year.
Absolutely. So as part of Adam, apologies. So Jalil, so just as part of, again, the reopening, if you were to relook at newer opportunities, would you keep the same positioning or, let's say, demand segmentation of your existing portfolio as to the newer opportunities, or you would want to switch into something more luxury or more budget or more economic? How would you look at that?
Well, it'll be more or less the same answer I made to your first question. It's a little too early for big changes. That's one thing, and it's again not so easy to anticipate. So we're very modest in our reflection and our analysis. We just need to remain vigilant and stick to our business model. We know many things will change. We don't know what yet, as Adam said, we need to be just opportunistic, stick to our model, and perhaps another model is based on joint ventures, co-investments, and mutual trust between the investor, the main investor, and the operator, and that's it. So we'll go really step by step in a very pragmatic way. This is not scientific; it's human business. And will evolve as one of the very first panelists said at the beginning of this conference. You have some of us believe there'll be big changes, and some others think there will be very little changes. I'm myself very in between, so it's not easy to read the future now.
So let's call it moderate changes then, and be diplomatic about it. So Adam, maybe just as part of your, let's say, one of the conclusive remarks, let's say, considering, the fact that you guys own Anfa Place, which is a commercial, obviously iconic center in Casablanca, but also being an international investors, do you foresee any difficult barriers to entry, in respect, if you were to underwrite a hotel acquisition in Morocco? From my own experience, some of the things we've seen, I think we want to take advantage of the fact that in the audience we have members of the Ministry of Tourism and members of the Sovereign Fund, just for us to get that sort of feedback from international investors such as yourselves. Do you see any barriers to entry, in particular anything pertaining maybe to labor, unions, some sort of capital repatriation if you want to export your dividends out and give them to shareholders, any withholding tax, operational issues, any of these elements effectively that you do have to keep into consideration when you analyze opportunities?
Yeah, thanks, Amir. I think in general terms, we are quite comfortable with the way that Morocco sets up as an international investment destination. I think it is very attractive to us. I think where it becomes very interesting is the recent promulgation of REIT legislation, the OPCI legislation that's come into Morocco. Is very interesting for us. It certainly improves the prospects from an international investment point of view to our type of structure. I think really that's what we will be looking to do going forward. We've sort of we've announced as a group that we intend to set up an OPCI in Morocco to house Anfa Place, as well as future pipeline opportunities. So I think the pipeline that we're looking at in Morocco is very much, it's industrial focused. I think is one of the main elements, but we are considering hospitality in Morocco currently as well. So it becomes very interesting because some of the challenges that we currently face in the current Anfa Place structure are negated by that new OPCI legislation. So I think for us, it's a priority to work through that process to get that structuring in place. And I think what's interesting is that what we believe is if we don't do that, I think we'll become very we will battle to compete going forward because our yields that we can offer in Morocco outside of a REIT structure or an OPCI structure won't be as competitive as the local players are able to offer on the ground. Right. So, if we're in a structure like that, if we have the benefits of the tax incentives and the sort of structuring that an OPCI brings, we can be as aggressive as possible on acquisitions and achieve those minimum returns that I spoke about back in Mauritius a lot easier. Outside of that structure and competing against people who have obviously got those structures set up is going to be very difficult for us going forward. So it's certainly a priority. I hope that answers your question. I think in the current structure there, I guess in the sort of vanilla structure of how we sit in something like Anfa Place at the moment, there is challenges, but I wouldn't say that Morocco is any different to the other African jurisdictions that we invest into. And just the amount of international sort of exposure and the amount of international interest in Morocco certainly makes it a fantastic destination for us in terms of building future pipeline and having future growth in the country. It's a firm target of ours.
Listen, that's very clear. Gentlemen, would you like to have maybe Jalil, any conclusive remarks before we pass on the mic to Matt and the bench team?
Well, globally, since there is a focus on my country, first of all, I'm very happy to participate and just to be another witness, as it's been said before me, that Morocco has fought strongly against the pandemic. Now, from the human perspective, we are in a very positive, let's say, trend. The state and the government has put a lot of energy, a lot of consistency in its efforts and its policy, and a lot of coherence. Now we are trying to discuss about reopening the country step by step with all the necessary sanitary conditions. We think the situation is promising from now until hopefully before summer, and we go this way. So we're quite positive, even though it's been tough on everybody and every business.
Inshallah khair. Thank you, Jalil. Adam, any conclusive remarks?
No, I think from my side, Amir, we obviously look forward to things opening up again. I mean, we, I guess, excited about some of the vaccine rollout that's happening. I think, I think we have to believe that that's going to make a big difference in economies opening up, business as usual continuing, and certainly that's we positioning ourselves for that situation. And I guess what to put a positive spin on things before we leave is we see some great opportunities coming out of this. I think we have to be positive about the sorts of opportunities that are going to present themselves. A lot of I guess businesses' weaknesses have been exposed, unfortunately during this time, and there will be opportunity. And I think we look forward to getting involved on the ground in Morocco as soon as the borders, are really open from our side in Mauritius, and engaging with, tenants, landlords, co-investors on growing a portfolio. And I think even more so, there's going to be appetite to do so, because I think, people are really going to seek out that opportunity, which is going to come about in these markets.
Fantastic. Gentlemen, it was a real pleasure having you on board with us. Thank you, Matt. Back at you.
Thank you.
Yep.
Thank you, Emma. Thank you, Jalal and Adam, for joining us today. And thank